We're in a very, very weird time, I would say, where a lot of us have never witnessed before. Something very unusual that gets us all in a very strong position to kind of make new adjustments to how we roll on our day-to-day. And we're going to talk about investor relations today, which is a very crucial point when it comes to fundraising cycles at any given stage that your company and your venture is. And we are going to be talking about how to react in times of crisis to this whole management operational feature where you may, we're talking about investors. So we're talking about also investors that we haven't been contacted with before, but also investors that already invested in our company, and we want to maintain a good relationship with them. So those are two important channels that we have to understand and be a little more sharp on our edges on how we actually act on those. We're going to open the stage. We have an open stage for Q&As. You can look at it. You can look it down at the scroll bar. Already have at least one question coming in. Feel free to jump in and just throw in questions. We'll try to tap all of those in between. I want to welcome my good friends. First of all, our very own Tzvika Gross, who is a partner at BDO in Israel. Tzvika is also the head of the financial outsourcing services operation at BDO. I also want to say hello to our good friend Brian McMahon, who is the CEO and founder of Expert Dojo. Well, probably one of the leaders, or maybe the leading accelerator in Santa Monica. We're going to hear more about what you guys are doing soon. And I also want to say good morning to Jonathan Hung, a good friend of ours, who is a co-partner, co-manager, co-partner, co-founder at Unicorn Venture Partners. So first of all, good morning to all of you. Tzvika, good afternoon. Why don't we start with a very short round of 2-3 minutes introduction from each one of you, just so we'll have our attendees understand who they're facing. Tzvika, why don't you start? We'll follow with Brian. Jonathan, you're going to close this one.
Thank you, Tomer. So yes, like Tomer mentioned, my name is Tzvika Gross. I'm a partner in BDO in Israel. And I head the department for the BSO services, meaning the outsourcing services. We focus a lot in the vibrant startup sphere in Israel. We assist a lot of the startups in Israel throughout the different stages of life, starting from the seed companies, going through the different stage of raising money. And in the same time, we also provide admin services to many of the big VC and PE funds that operate in Israel. So we are also very highly involved in the other side of the market where the money is being deployed. So we see both sides, and we see how the two, not rivals, but actually the two players, play the game with each other. And we have seen many companies who have done a great job not only developing the product, but also pitching it and raising the funds, whereas some others who might have a great product, but they didn't know how to approach the funding sources, such as the funds or angels. And we help those companies in the different stages with all the, we give comprehensive solution and environment that help the companies not only dealing with their finances, but also planning and presenting their plans and their achievements. And that's a very essential part of one's approach to the market. And I'm sure we're going to discuss it today.
Hi, Brian here from Expert Dojo. We're an early stage accelerator in Santa Monica. We invest in companies generally from abroad. We've been investing in a lot of Israeli companies to date. We will generally put $100,000 checks in. Our focus is wide. We've invested in our previous cohort everything from deep enterprise tech through to blockchain, through to medical device, and we even brought in one cannabis company as well. So we're very, very wide. We generally just look for great entrepreneurs looking to do incredible things. Tomer and I and BDO go back a long way. BDO have been phenomenal champions for Expert Dojo over in Israel and Tel Aviv. And we've been over there many times, and we will continue to come back over there looking for the best entrepreneurs on the planet. And just final thing is we're open for business. We're investing in twice as many companies today as we did 6 months ago. And at that time, we were investing in twice as many companies as we were before that. So glad to be on the call.
Hi, good afternoon, everyone. My name is Jonathan Hahn. So as one of the managing partners for Upfront Ventures Partners, we invest in consumer and technology industries. We are pre-seed, seed, and Series A venture fund, but we also sit on top of another bigger organization called Untitled Ventures, which is a family office, which is run by my good friend and partner, Serafin. We look at opportunities anywhere from idea stage, NAC stage, all the way to eventually taking you to the IPO. That's the capital we can do for you. Unicorn, what we like to do is we write check sizes from 50 to 250,000 from the seed and pre-seed, and we write a little more in the Series A. But then when it comes to Series A, we go 250 and more. And we really look for opportunities everywhere. I mean, obviously, some of the most recent ones we've done are locally here in Los Angeles and Silicon Valley. We're not country specific. We just look at great teams when we look at great investments.
Thank you, Jonathan. We had some problems with the reception over there. You were a little cut off. So I don't know if you can try and fine tune that, make it a little stronger, a little more fluent.
Yeah, I'll try. Weird.
All right, for some reason now it's working. I don't know what's wrong, but now it's working. All right.
So weird.
No worries. We'll dive in. I wanna first of all thank you very much, guys. It was again. I'm happy that we have such a distinguished panel to discuss those matters that we wanted to address the audience. I want to start and tackle with just a couple questions that I'm going to present to each one of you. I'm going to start with the first one, and I want you to recommend to an entrepreneur today what to withdraw or dismiss when they're presenting their operation to an investor. So look at this from an investor perspective. You're looking at this entrepreneur, he's coming in. What is the best thing that you can say out of your experience that they can withdraw from their presentation, just not to jeopardize their chances to succeed? Why don't we start with you, Jonathan?
Yeah. So I think the most important thing is, especially when you're starting off, is not to have like a lot of financials. I mean, it makes no sense. Like when I see a 5-year pro forma, it makes no sense because like I need to see how good your team is first and to get your first customer. You're talking about like 1,000 customers down the road, like, oh, we're going to be a unicorn and by year 3. Like no company starts becoming a unicorn in year 3. Some do, some might. But I think that's just ridiculous. So I would think you're really your roadmap to how you're going to do your customer growth and how you're going to get to your first 100,000 in sales. How you can get to an MRR of 100,000. Because from my point of view, from pre-seed or seed, that's what I see going forward. I'm not trying to get you from like, you're worth 5 million to be worth $1 billion the next day. It's like, how do I see you grow from 0 to 100,000 revenue and then from 100,000 to $1 million? And then from there, another team's going to take you forward.
All right. Brian, you want to add in?
Obviously, I agree entirely with Jonathan. So there's a phrase that no entrepreneur can ever say, and that is, if I can just capture 1% of this market, then I will be worth, ba-boom, Just don't ever say that. Don't ever put it in your deck. Don't ever say it, because it's just a joke. Because the largest companies in the world have difficulty capturing 1, 2, 3% of an entire market. And I very much follow the philosophy of Jonathan, of what he says. We call it island hopping. So what we do is, if we see a company, especially if they're just beginning on sales, so let's say maybe they have a revenue right now of $5,000 or $10,000 a month, then we want to see how they hop from the first island to the second island. So the second island may be $50,000 a month, the third island maybe $100,000 a month, and then the next island is $1 million a month. And to John's point, we're not looking for 15 pages of beautifully put together pro formas by your accountant that looks glossy and gorgeous and shiny. What we want to know is, specifically, based on what you've learned to get to $3,000 or $4,000 or $5,000 a month, specifically, what are you going to do with our money and any other money that you get to bring yourself to 50? And does that look like Facebook ads? Does it look like partners? Does it look like affiliates? And specifically, what does it look like? And then we want to know, like, where do you go? Because normally when you get to 50 or 100, to John's point, you have to do something entirely different to get yourself from 100K a month to $1 million a month. And that may be a new product. It may be a new offering. It may be new customers. There's lots of things, but we want to at least believe that you have thought about how to jump to that level. Because once you're at $1 million a month, then, you know, it's going to be down to execution and luck. But the actual physicality of how you grow and what you do, most of that, the difficult part has been gone through.
All right, Tvika, they pretty much said that your job is pointless at this point, but what would be the recommendation from your end, from your experience?
Well, first of all, I have to admit that my first advice to the new entrepreneurs who build their startup is not to get so madly in love with the numbers they present in their business plan, and don't get deceived by their own numbers. And I think in general, numbers and business plans mostly present ambition and not a real plan. Ambition is also a great ingredient for success, but it's not all of it. Now, I mean, my friends here spoke about revenues being big or small. I mean, that's already lucky to have revenues. I mean, we deal with a lot of companies that are working on IP where the revenue stream or revenue plan is not even so formalized. And I think that's fine in today's world if you have a real product or service or whatever that you're developing, then not having a crystallized plan on how to monetize on your IP or on the service you develop is good enough. Again, depending on the stage of your company, but if you're in a seed spot, then that's good enough for that. Of course, you know, in our plans, we do show revenue because the ultimate goal is to have revenues, but I do agree with Jonathan and Brian that the long forecast, 5 years of making billions of dollars, that's not the key to get the attention of the investor. I think what Jonathan said at the beginning is the key to success. I mean, we all know when one invests in a startup, he mainly invests in the people, right? So that's the number one thing. So if you get the right people and their ambition and they're devoted and they know about the market they're playing in, then the investor will have more confidence than getting people who are a bit, how would I say that, not ambiguous or not focused, but they have a good business plan. That's not going to work. No investor is going to go for that. That's a major difference between investing in a startup, in a seed company, versus investing in a later stage mature company. You invest in a mature company, you invest in numbers. Invest in a startup, you invest in people. That's important when you decide who to bring on board to your team. Make sure this team member is a winner, is somebody you can present, and it comes with a relevant CV or experience. Now, this is the number one rule. I think if we're just going to tap your introduction to this webinar, we're in weird times. We're in the essence of, black swan, things that nobody ever imagined happening. And I think it has two parallel impacts. I mean, there is a real impact on how do we tackle the risk, and there is also the psychological impact, because us as humans, it's very difficult for us to fathom or to calculate the risk in its real in probability, and it's all like a matter of assumptions. And in normal times, when black swans don't happen, let's say us half a year ago, we undermine minor risks, and once we hit Corona, we overestimate risks. So when you are a startup and you present your team and you present your idea, you should have in the back of your mind, I mean, investing in startups is a risky business. By definition, is a risky business. It's a venture capital. However, when you approach an investor and you show him what you have to offer, you should put more emphasis in your plan and in your pitch on the risks that are embedded in the things that you're developing or offering, or in your business proposition, to show that at least if you don't have a solution for the risk, that you have taken that into consideration, and that's part of your global assumptions that you've factored in, and that is something that you did not ignore or neglected. I think that's a very important part of the pitch.
All right, so Tzvika, I actually have a follow-on question for you on this one, because I wanted to ask you from a finance and maybe even tax perspectives, what do you think are the strong points to enable when you manage the business and the books of a company, of a startup, in order to be as inviting as possible for a foreign investor? Now, our friends from California, they did say that they don't care about the 5-year plans, and the numbers are not as important as who is the team, what's the idea, the vision, the integrity, and etc. But eventually, I'm sure that when you come across a startup that you're supporting and going hand in hand, I'm sure that there are some points that, also from risk factors, you as an advisor would tell them, listen, this is something you don't want to talk about, and this is something that you definitely want to bring up and emphasize when you're approaching an investor.
So yes, I mean, I think when you talk about finance and books and financial management of your enterprise or your company, it's not an enterprise yet. I don't think that our times is different than previous times. I think the key rules remain the same. Nobody expects you to, as John says, to have a glorious or glorified 5-year plan. I think the most important thing is that the investor get the confidence that what you show him is what is really happening, and that you're managing and you're able to manage your finances so that if in the future anything will happen, it will reflect properly and he will get the proper information on a timely manner, and he gets the answers he needs. So more than the numbers need to be pretty, the numbers need to be reliable. And that's a key thing for an investor, the confidence, and confidence is the name of the game, because that's what makes the difference. And therefore, if you make a plan that's by definition flaky and makes no sense, as good as it comes out, gives much less confidence than if you make a real plan with a sensitivity analysis for different factors, and where the investor can show, or your reporting, your books and your reporting can show how you're tracking it, how you're monitoring what's happening. If you have the basic, actual versus budget analysis, and you can show where the deviation is, and you can explain why, then it's better than trying to have nice numbers, but not be able to track budget or to explain what happened. I think this is the key thing when it comes to finances and to financial tracking. And when it comes to taxes, I think that's a whole different aspect, because when you think about taxes, you usually come only after you have the income and the profits. In an early stage, where usually we're talking about startups, it's mostly about tax incentives. So obviously getting a tax incentive is a huge plus, and different countries, different jurisdictions has different incentives. But the key thing, I think that if you meet with an investor, he wants to see that you have investigated your options and you come prepared and you know what's relevant and you know what's the probability that you're actually going to win it. So this thing is not neglected. Again, proper management is the key and is the name of the game, more than just giving fantasized predictions about the perfect world that's going to happen.
All right. Brian, Jonathan, do you want to tap that when it comes to financial stats and tax, any kind of tax implications?
Jonathan, you want to go? And I'll follow.
Yeah, I'll go first. I mean, from our perspective, I mean, like, it's not that we don't understand necessarily the European market or Asian market or Israeli market, but sometimes when we feel more comfortable, especially for our investors, we want to invest in companies that have a local presence here in the US, because no matter what, I think any company wants to still come here, you know, and make money, revenue from our economy. So you have to look at understanding like how you should incorporate here. Should you be an LLC or a C Corp? For our point of view, we like to deal with LLCs or C corporations. I know other funds who are doing Series A and higher. For example, there's a venture fund here called Upfront Ventures. If you're an LLC, they won't invest in you. They don't care how great of an idea you are. It's just for their fund, they only invest in C corporations. So you have to see where you want to get the money from and how you want to incorporate. Sometimes you might have to change. You might start off as an LLC and then become a C Corp down the road. But that way we understand the jurisdiction, especially because like if there's anything, God forbid, that happens, like that hopefully we don't have to get lawyers involved, but if we have to, that we understand that, oh, it's our jurisdiction here when we're going after certain issues from our companies.
Yeah, and I also want to re-clarify a point from earlier on. Like, neither Jonathan nor I are saying that accounts and financials are not important. The opposite. Like, we care massively about financials. The decisions that we make are based on clues from the past so that we can make assumptions for trends for the future. What we're saying is, don't just feel that you wake up one morning and you can just go in and get somebody else to fill out 5 years' numbers. And just because those numbers equal what those numbers should equal, if you're going to be a unicorn, suddenly it's like, oh my God, we've done great. Like that BS, those days have gone. Like, so the situation we're in right now, it's not a worse world or a better world to the point that was made earlier on. It's a different world. For us, we're investing twice as much as we did before. Why? Because we know in times like this, we can pick up phenomenal companies. We know that the water is no longer muddy. And what I mean by muddy is any idiot can build a phenomenal company in the best of times if they're lucky. But only great entrepreneurs build phenomenal companies in really difficult times. So it's much easier to see the folks that are really building traction. So yes, make sure that your accounts are 100% good. Make sure that your financials are absolutely specific and they are based on what your company either is doing, or if you're a new company, what other folks who are in your space are doing, with very specific numbers to back those up. Because we're not going to have a conversation which is going to talk about you bringing in $40 million in revenue in 3 years' time based on X, Y, and C BS factors, which have no relevance to anything, right? We want you to be very, very, very specific about the hows and the whys. And the word that Jonathan mentioned at the very beginning, milestoning, is the most important word of it all, whether we call it bridge hopping or island hopping or anything else. So that's number one. So number two, this is the greatest time for entrepreneurs. I'll get to America in a second and tax and everything else, but it's the greatest time because everything is cheaper. Everything is cheaper. The investors are only investing in specific companies. The larger companies that you're competing against are cash flow restrained. So you can actually fight a much better fight than you would have been able to before. And you get to find out who your real friends are. These are not fair weather friends that you're bringing in a really good times. They're people who are going to stand by you in bad times all the way through. And Jonathan's right. We've had a bunch of companies that are Israeli companies based in Israel come over to America. Extremely difficult to raise investment for them. Probably, I don't want to give a specific number, but a very, very high percentage of funds in America will not invest in a non-US incorporated company. So you have to think about that in your investment. Now, we will, because if we see that the company is going to be coming over here anyway, and because we really like the ecosystem in Israel, from our perspective, it's a smaller gamble to actually do that. But generally speaking, if you're a startup over in Israel and you're saying, okay, I want to break into the American market, I want to get investors over in America, you are probably better when you get there, making sure that you do incorporation exactly as Jonathan said to you. We think very little about tax implications at the beginning, in all honesty, Tomer. I think that becomes a consideration when folks get to Series A and beyond. At the start, they just need to make sure that the incorporation of their company is done in a way that they're going to be able to get the investment that's going to be able to help them grow to the next level. And then I always incorporate in there, just don't be an idiot as an entrepreneur. If you have a company, if you're going to grow it, don't take all of your expenses out of your business account. Don't just, run haphazard through and build and say, oh, it'll be okay when we get more money in. We'll bring an accountant in. Make sure that right from the very beginning, you are treating that company as if it's going to be acquired in 6 months' time, or that you're going to go public in 6 months' time. And every single thing you're doing, from your payroll to your 1099s to your tax to every other financial instrument that you need, that you have it in place at the start. Think like a startup, but act like a corporation.
All right, I like that. And again, obviously, finance and money features are very, very important when you're examining an investment. I did not imply that money doesn't matter. Money matters because eventually you need to make profit on your investments. So thank you, Brian, for clarifying that, Jonathan, as well. I think that what I'm taking from your answers is pretty much risk minimizing from legal perspectives, as John mentioned that. Also transparency. You want to see that on your home court. You want to make sure that it's where within the boundaries of the rules of the game that you know how to play. And I understand that. I think that it makes a lot of sense. My next question is going to be discussing about existing investors. So I want to ask you, from an entrepreneurial perspective, of course, when maintaining a relationship with an existing investor, so it's an investor that's already invested in your company, is already dived in, what is important to do in order to keep the connection on the positive side, especially in times that are similar to what we're facing today? There's a lot of uncertainty up in the air. What would you call is the major red flag from an existing investor's perspective that you don't want to see coming out of your investment side? So Jonathan, Brian, one of you, I think we should start this one.
Okay, I can start this one. So you don't be immediately desperate, right? Now, and most startups will say, or don't give the perception of being immediately desperate. And most startups will say, but Brian, we are immediately desperate. Like, we need money today. I mean, to try and do it. But there's two types of entrepreneurs, again, in this scenario for me. There's the one type who deal phenomenally well with resilience. And their viewpoint is, listen, I don't care. I'm either going to get investment or I'm not going to get investment. If I don't get investment, I'm going to find more clients. If I can't keep staff, I'm going to work 3 times harder. I'm going to outreach more. I'm going to find people in the Philippines who are going to outreach for me. I'm going to do. My company will not fail, no matter what happens. This is not a game of finding investors. This is a game of building phenomenal companies. companies of which investors are a component. And then you have a much larger majority of people who panic like crazy, and you can see it in their emails. We need money. We need to have it through. Like, we need to grow our business. We're in trouble. We got to find stuff. And that for me is a huge red flag. If I see people who are in trouble, if I see that, folks, not that they don't need money, but if I see folks that their business will potentially die if they don't get money, for me, it just means we're delaying something that's going to happen in, 6 months, 3 months, a year's time. What they should do is send extremely regular updates to their investors, telling them extremely transparently what is going to happen in the future if certain things don't happen. So for example, if I see an email if I see a regular, and I underline the word regular, email from an entrepreneur who's interested in being in our accelerator program, and that entrepreneur says to us, look, Brian, here's where we are right now. Here's where our users are. This is what we need investment for. This is what the investment is going to do. If we don't get investment in 2 to 3 months' time, it will definitely stop our growth as we want it to be in 4 months' time, and it will affect us in this way. And I'll give you one very quick example. We had a company called Champions Round, who are a fantasy league company, who are actually based over in the US. And we saw them first, and we didn't like them, and we didn't feel that what they were doing in fantasy football was actually going to be something which was going to be a big game changer at the time. And then they kept sending us updates of stuff that they'd done. So the first update was, you're wrong. And we're going to show you that you're wrong. And I'm like, great, that's lovely. Then the next update was, hey, we've just done our fantasy league, and it's going to be a weekly league rather than a yearly league. So we've differentiated ourselves in a strong way. Great. Next update was, we've just had this person in in the football league over here, a big linebacker who has actually aligned themselves with it. And I'm like, oh, hold on a second. They don't need me. Like, they wanted me, but they don't need me. And then the next two updates were similar types of things. And then we invested in them literally a month later. And now last week, Friday, they just pulled in a round of $500,000 from one of the VCs in the gaming space. And suddenly, our valuation has jumped up by 3 to 4 times, right? So it's something that's extremely important. And I will say, conversely, on the other side, we had a company called Obscure Games over in Israel, who I really wanted because, and actually a little bit to the point on caring about team, I think they have one of the best gaming teams on the planet. And we never know when a unicorn is going to come, but we see teams that we know are not going to fail. So I'm saying it here on the podcast. For me, Obscure Games, fast forward 3-4 years time, will be our unicorn, and I will not forget that company came from BDO. But we tried to get that company at the start, and we sent them updates. They didn't send us updates. This is a two-way street. They didn't want us at the beginning. We had to court them. We had to tell them why we were good. We had to explain why it was really important, why they come with us. So this is no different than having a relationship with a couple, no different than wanting your dream job. You make sure you build a relationship through great, consistent communication and not desperation.
Yeah. I would agree wholeheartedly with Brian. It's all about communication, because it's also getting your message out there. Just like us doing this broadcast now, it's about PR. I mean, it can't just be about a money relationship, because from my point of view, like, if I get an investment from an investor, that's not all I need from them. Sometimes it's introductions that I need from my portfolio companies that are just as important. Maybe someone knows somebody at Amazon, or somebody knows someone at Walmart for a consumer product, or there's somebody who's a really good CTO that we need to bring in for our company. Those are just as important as just writing a check. And really, I think for an investor's point of view, like, they want to see quarterly updates on how their investment is doing. And so obviously it's unrealized gains, or, unfortunately unrealized losses at times, but they want to see the traction. I mean, the worst is, like, imagine if I gave money to a portfolio company. In the beginning, they love you. They tell, oh, everything's going great. And then they disappear. And you have no idea what your investment is doing. Could you imagine if I did that to my customers, my investors? Why would they ever trust me for giving me money down the road? It's crazy to think, but some people do that. And also, it's also setting up the conversation for maybe there's other co-investment opportunities where it's like, we've already made our investment, but maybe our investors, they love a company so much more that they're willing to put in even more additional money to help our entrepreneurs go further.
All right, Savika, do you want to add on this?
Yeah, I would like to. I always tell the guys that I work with, our clients, including obscure games. We tell them relationship with partners, with investors, start when they invest the money. It doesn't end when you invest the money. Seems like, startup entrepreneurs who are in the vicious cycle of, on the one hand, getting their product or their service being developed, and then on the other hand, getting the money to support this activity. They're like wrapped their head around like getting money, and once they got the money, they just forget about it and move to the next, either to the next development or to the next investor. And I say this is a mistake. It's a strategic mistake. Because a guy who put in his best money into your company, he wants you to succeed just as you do, and he will be there if you manage the relationship in a proper way. He will be there when you need him with his connections and with his ideas and with his experience from other areas of business that he usually has. And like Brian said, it's like any type of relationship. It's like marriage. It's like a partnership, a job. You have to maintain the relationship because the more you invest, the more you harvest. And as much as every company needs to, raise money and be bothered and consumed with the process of raising money, which is no doubt one of the hardest tasks for young entrepreneurs who come from usually different areas of, developing or being an engineer, and here they have to pitch their business idea, which is totally not natural for them, and it demands a lot of change and a lot of adaptation for them. But in the same time, you've started a relationship with an investor. Keep him on board, keep him part of your team, keep him updated, whether it's good or bad. Never, ever hide the bad things. Be transparent. Give them the confidence that they're part of the team. And this is how you will gain their partnership, their confidence, and they'll be there for you. Obviously, at the end of the day, you have to perform. Obviously, that's the point of the game. But it's a long way to go, and you need them in your good times and in your bad times. So, again, this is a partnership. This is a relationship that you have to cherish and nurture so they will be with you when you need them.
All right. Thank you, Zvika, Brian, and Jonathan. We have some questions coming in. We're already getting ready for our closure timings. So we're going to try and tap those questions as quickly as possible. I have one question from Ravital, who's asking, hi, I want to know what catches your eye when looking at a prospect investment that is a pre-A round, and is it different when it's an early stage at a pre-seed level? Brian, I think you should answer that first.
So, I mentioned a word at the beginning, which is the word believe. There are certain folks that will go through a pitch deck and you finish the pitch and you don't really believe they know that it's going to happen. And then there's other folks like the guys in Obscure Games that we took in, where we absolutely know it's going to happen because they absolutely know it's going to happen. And they demonstrate certain characteristics which steps outside. I really think pitch decks are a curse, because what happens is you move into this place of selling. So you're here and you're like, okay, I got like 14 slides in a deck, and by the time I get to the end of these 14 slides, I'm going to have sold you to invest in me. And it doesn't really work like that. Humans don't really work like that. Well, what happens is we got two parts of our brain. Like the first part of our brain, the only objective it has is to get rid of dumb ideas as quickly as possible, or just things which are distractions as quickly as possible, so that our brain can really process whatever amount of things that we're actually able to process. So a lot of the time, within 30 or 40 seconds, we've decided that the company isn't going to be a company for our cohort. And it's because we don't believe. And the thing that we have to believe in is that huge vision. So we have to be able to see, because remember, every single VC, now these are not angels, they're VCs, folks like ourselves and Jonathan. Every single VC will invest in, we're doing 50 companies a year, but within those 50 companies, we know that to repay our fund, we probably need about 2 or 3 of those companies to make sure that we can actually, start reaping the harvest after that. So we need every company to have a huge vision, and then they need to be able to show us those islands that they're going from one island to the next island, whether it's revenue, whether it's users, wherever it's going to be, so we can see that that vision is going to be achieved.
All right, Jonathan, we're talking about the differences between pre-seed and pre-A. Now, how do you differentiate the process when you're looking at companies in those different stages?
Yeah, I think no matter what, really, you're still trying to get product market fit. And I think you're investable to a venture capitalist or angel investor or anybody when you can show one of four things when you're really early. I mean, you're going to need all four of these when you get more money down the road, but you need one of these. I think you either have to be a world-class team. You could show like why you and your co-founder or the current team members can work and how figure out a vision and get to profitability. Two, you have some sort of unique intellectual property. So like, oh, you're a world expert on, data collection, for example. Three, you can show me the path to customer growth. It's not that you have all these customers, but you could show me step by step how you're going to go from, the LA market to the New York market or to the Midwest market or to the Israeli market. Like, how can you show that you're going to get customers? And fourth is how you're going to monetize. What is your revenue growth? Like, how can you show me like step by step that this is how you're going to get revenue sales, and that way you're going to be able to have more money come in. Because the problem is that you have to show ability to pivot. There's no way that your pitch deck from the start is going to be the same pitch deck that you're doing like a year from now, necessarily even a month or 6 months from now. I remember back in 2012 when I invested my first angel check, I passed on one company and it was worth, their valuation was 20 million, and it was talking about gaming company. It was a game company at the time, and they're talking about buying and selling stocks. It was almost like fantasy stockbroker. And I thought to myself, who would play this game? This isn't Angry Birds, this isn't Fruit Ninja, this isn't Plant vs. Zombies, or Bedazzled or Bejeweled or whatever they're called. Who would care? But you know what I missed out on? It wasn't the idea, it was the team. This is a world-class team. And that's why I should have put in my $25,000 check then. Because this company turned out to be Robinhood.
Oh.
I turned out Robinhood at $20 million. And they just raised another $300 to $400 million. Right. And they're worth $8.3 billion right now. And you know what? They pivoted. They didn't talk about, you couldn't buy or sell stock at the time. You weren't talking about cryptocurrencies. It wasn't talking about, hey, we're going to sell our data to hedge funds to be able to trade. But you should have saw the team and thought, oh, okay, they could do it. It wasn't just the idea. So really, that's what I see going forward when it's really early.
All right. That's a great story, by the way. I can tell you my stories, but we don't have time about that. I have more questions coming in. One question is talking about, I'm allowing myself to just fast forward on these guys. Which sector is now stronger with a higher demand? Obviously, I'm giving the short answer. Obviously, everything that has to do with healthcare, medical device, anything that's medical is highly more in demand and more in the focus, especially in comparison to how it used to be before COVID-19 broke into our life. But I would definitely say that this is in a higher demand. And from past webinars that we've done, we're talking about how much more risk you have today because those kind of games or tools were thrown into the game, into the court. Another question that I have is, oh, you know what? That's a good question. So this is a very specific question. I have Roy who's asking, my venture is in the water tech sector, and I wanted to know if now is a good time to go on a seed round. He said they're looking at $1 to $3 million, and they don't have any revenues yet. Anybody want to take this one?
I didn't quite hear Tomer. He's in the water tech sector?
Okay, so his venture is in the water tech sector, yes. And he wanted to know if now is a good time to go on a seed round when they're looking at $1 to $3 million of a round, a seed round, sorry, and they don't have any revenues today.
Yeah, I mean, any time is a good time. Look, it's not about, as I said, this game is not about investors. This game is about building the very greatest companies that you can build. So if you need the money to do something specific to now, you have to raise now. Absolutely. Look, investors have not disappeared from the market. Angel investors have disappeared from the market in a large quantity. And that's a very, very different quantification. The venture capital investors know that the very best investments they're going to get is going to be at this time. Now, here's things you've got to take into account. Number one, the valuations are going to be depressed. But number two, maybe the valuations were never worth what folks thought they were worth 6, 9, 12 months ago. So they are going to drop down. Some people are saying they're dropping down as much as like 20, 25, 30%. But is that necessarily a bad thing? Because you can buy everything for 25 to 30% less than what you were going to buy before, including people. So every time is a good time to raise investment. There's no time people shouldn't be looking for investment. This is very simple. It's not a game of spreadsheets or a game of investment or a game of putting pieces here. It is about, to Jonathan's point, I have a product fit. This product fit is either good or it's bad for this time. I would argue actually that medical devices and hardware is extremely challenging right now. We've only invested in one hardware company because we're really worried about the supply chain. We don't know what's going to happen in the supply chain in the next 6, 12, 18 months. We don't know what's going to happen between the US and China. We don't know what's going to happen with all of it. So for us, it's a tough time. But if we look at areas like telehealth is very strong, teleworking is very strong, anything to do with replacing offices is strong. If you have a business that involves office buildings, then that's tough as hell. I think it's pretty clear. Gaming is obviously really strong right now. Entertainment is strong right now. Streaming is strong. All of the things that actually help enable a more online world are actually really strong. And actually virtual reality, which I've been very bearish on for probably the last 3 to 4 years, possibly is now seeing a chink of light where that can come through as well. But as far as your company's concerned, look, if your product fit is good for growth during this very interesting time, then you absolutely have to go for it. Why would you let your opportunity miss? If your opportunity is no better or worse than before, then you're going to be okay. Maybe it will be good, maybe it will be bad, but there's still no reason why you shouldn't do it. You should still move forward really strong as other companies around you are starting to fail. Yeah, absolutely.
I just add, Tomer.
Yeah, go ahead.
I don't know, again, I don't know this water tank, what exactly the product or what exactly the service is. But in general, this whole area, this space, it relates to infrastructure investments, and the main goal, the main money comes from governments or industrial sources, not from, B2C. And what we have seen in the past recent few months, that government involvement in these areas are rapidly accelerating. And, Tomer, together, we both have met numerous incentive plans from mostly governments and states in America that are all minded to invest in water, sewer, all these kind of solutions. So I think, yes, this is a good time if you want to take a pre-seed investment so that you'll have the possibility to approach and to bid on a government tender. This is your time. Again, I don't know the specific of this guy and where is he holding in terms of his product, but if this is your time, that this money can give you the leap from having just an idea to something that you can present to a tender, you for sure absorb the depreciation in value, get the investment, go ahead, because the money now, the governments are more inclined to invest in that. So that's definitely true.
And you know what? I'm taking your answers about this, about Roy's question, because it makes sense. First of all, the answers, I totally align with those. I think that you're both correct. I don't think that entrepreneurs should be waiting on the fence. I think that's the worst strategy, especially in those kind of times. I definitely think that Roy's question is coming from a very uncertain, I guess, feeling on the market, especially I'm assuming he's from Israel, but I'm sure that a lot of the listeners, a lot of the people from the audience can relate to Roy's question and where he's coming from. And that's the uncertainty feature that's up in the air when it comes to breaking into the market with a very early stage venture that you're running. So I want to jump, because we're really losing time here. I want to jump to our conclusion, and I want to start with mine first. I'm going to open with my conclusion. I think that I'm going to be taking from our conversation today a few things when it comes to managing your investors' relations operation. I think that transparency is definitely one of the most important things today, especially in times when there's so much risk out in the market. You want to make sure that your investors and the people that you rely on their financial backbones, you want to make sure that they feel that they are completely confident in the people that they've invested in. Maybe the product is not going to be that unicorn eventually, but they want to make sure that they invested whatever they invested and by whatever risk strategy that they made the investing based on. They want to make sure that they can look at the people's eyes and say, you know what, I can definitely see that what they told me is definitely what's out there. And that's a very, very important feature. Second is, and that's my main conclusion, and I'm sure you're gonna talk about this, so I'm gonna make it short. The markets are not done. The markets are not dead. The markets are not closed and waiting for any kind of an emergency exit strategy by anyone. I think that aside from, just like Brian said before, aside from angels investors, we see that money is definitely playing right now on the courts, and a lot of investments are being done. Probably more than before. A lot of people are taking advantage of this situation. Great opportunities to invest in. Great people out there looking for interesting investments, and the strategy should be just go strong. Be more eager to get more introductions and more engagements for potential investors. That would be my conclusion. Zvika, you want to give your 2 minutes conclusion?
I do think, unfortunately, that there is some hesitance in the market now, where people were, fast forward an investment are thinking twice. However, I do think this is a temporary thing. If you look at the market as a whole, situation we're living in today, where in essence, the interest rate is zero. I mean, if you compare that to 2000, interest rates there were significantly higher. So today, there's no other real investment opportunities. And another thing that happened is that investing in startups or venture capital has become mainstream, as opposed to few decades ago, where that was something nobody even thought about. People would like to invest in mature companies. Today, you've seen small companies who became unicorn and huge and big and billions of dollars. So people see that this is feasible. So that did not change, and the money is still there. So yes, now with Corona, it's a matter of a month or 2 or 3. People are a bit more or a bit less hesitant. Yes, but that's not a game changer. It didn't change the market. The market is still here with money to deploy and allocate, and looking for the right investments, and believing in the fact that you can make apps that could change the world. You can make Waze, and you can make WhatsApp, and you can make other things that we've all found to be startups that change our world. So people are keen to invest. And the other thing is, again, what you said, Tomer. When I have a startup where I come into my office, I ask, and he's about to go on a roadshow and ask for a fundraise for investment. I say, pretend I am your investor, potential investor. What's your pitch, or why would I invest in you? And then he starts, and I don't even listen to what he's saying. That's the truth. I'm looking at him. And if his first instinct is to turn around and show a presentation or a number or a spreadsheet, meaning that he's hiding behind the numbers or hiding behind the vision, that's not a good game. I tell them you have to sit up straight, forget about the papers and forget about the deck. I mean, you should have it. If people want to see it, you should show it. But your main product that you deliver is yourself. And if you look at the eyes of the guy investor and he talks straight and you know what you're saying and you can clearly and crystal clearly summarize your idea in few sentences and it makes sense and you look confident in it, this is what you need. And this is extremely important for a pre-seed, because when you're in a pre-seed, there is absolutely nothing else that you bring to the table besides that. Definitely not the papers. So these are the two things. The money is here. The market didn't change. The space didn't change. It's a temporary thing. All this reluctance, the hesitance for investment, it's a very temporary thing. You have to bring the main product, which is yourself.
All right,
John.
awesome. Jonathan, why don't you take the floor? Give us your conclusion.
Yeah. For me, we're heading to another recession right now, but it doesn't necessarily mean that there's not opportunities to grow. I mean, it's all about timing. Like sometimes success, I always think success is 50% being prepared and the other 50% is just having luck and having the right timing. I mean, I remember the Great Recession in 2008, 12 years ago. And I thought, like, if I gave you a pitch deck that said, like, would you get into some stranger's car, instead of like, a chauffeured car? Or would you stay at someone's guest room? Would you have invested? It wouldn't have made sense, but these are Uber and Airbnb now. And these are, brand, everybody knows these brands now. And so look at before, like, when we looked at food delivery isn't anything new. But now you have Delivery Hero, you have Postmates, you have Uber Eats, you have, I always forget the other one I use all the most, DoorDash. It's like, it's about timing, with the new gig economy and the shift from online to mobile, people are interested in finding new ways of doing business and conducting business. So for me, you always have to look at a company who's willing to pivot, and look really early, to see how you can achieve it. Right now, I think, if you're a software company, if you're a B2B company, it's going to be a little harder because most companies right now are in survival mode and they're cutting their staff and trying to find ways to save money. So maybe the best way right now is for you to have a business that's going direct to consumer. That's so much easier to achieve because, like, I have a credit card or I have, PayPal or Venmo or whatever I have, and I can make a $5 purchase, a $10 purchase. That's easier than, like, hey, setting up, a multi-million-dollar, $1,000 a month, software company, that I have to charge. So really it's about timing and looking at your opportunity and being able to pivot and having grit, because times are tough. It's not going to be easy to just get money so easily. Oh, like, yeah, I'm an alumni for Airbnb and I have an idea. Oh, okay, here's 2 million. Like, it's not that time anymore. So you have to really show your relentlessness now.
All right. Thank you, Jonathan. Brian, the floor is yours, man.
So what startups need to understand is most VCs, most venture capital firms do not provide a positive return back to their investors, right? So it's actually a very, very challenging space. Some of the bigger firms and the more niche firms get the returns, but most of them don't get the returns in normal times. So when times like this come, actually most venture capitalists look at it as a way to be able to boost those gains and to be able to get better returns, because they know what happens. They know that whether it's the Pinterest or the Instagrams, or to Jonathan's point, like the Ubers or the Lyfts, or even going back to, the Groupons, which is probably the most famous one, recessions is where some of the greatest innovations on the planet come from. We all know that. So if you don't have your idea yet, I love what Jonathan just said there. Really look to frictionless innovation. Look to ways that folks actually desperately need things today to make their life easier, because a huge company is going to be born from this. And if you already have a product and it's already in a space, again, you want to try and make sure that you show as much growth as possible. Like I see behind you with the old camera that you have there, and we think of the times of Kodak, which we don't even know anymore, right? And how that changed to iPhone and everything moved over to that way because they made it extremely frictionless for people to be able to do something they love and then share it with lots of other people. So as a startup, Israelis, and I think 99% of the folks who are going to be listening to this are Israelis, have an advantage over other people. When times are terrible and they're tough and recessions are coming, people are afraid. And when people are afraid, they want strength. So use the strength that you have been given over the years through each thing that you've gone through to now show leadership as you drive your startup through. Never ask a question like, should I get investment? Shouldn't I get investment? This is your time. Be aggressive, be bold, be brave, and build something huge.
All right, awesome. I love your inspiration. Again, I think that the bottom line is that the market has never been more alive than before, than today. I'm sorry. I think that with that being said, and the great examples you brought up on the part of the conclusions, saying that just like in 2008, as Jonathan mentioned, that this could be the 208 in 12 years from now, this time that we're looking at, and we're going to be looking at things that probably are as bizarre as we can think of as today, but are going to be completely trivial in 12 years from now. So with this bottom line, again, Jonathan Hung, Brian McMahon, Zvika Gross, I want to thank you all for joining us today. It's been a true enlightening discussion. I liked it very much. I think that we brought a lot of essential tools to the table, and we did have some more questions that were sent out by our audiences. I'm going to try and circle back with you guys over email, and then distribute that to our listeners and the people that sign up for the conference. Again, thank you so much. It's been great. Have a great evening, Zvika. Great day, Brian and Jonathan. And thank you for the audience who's been listening to us. All the best for everyone.
Thanks, buddy.
Thank you.